Something strange is happening inside the US economy right now. Inflation has surged. Interest rates are at their highest levels in decades. Consumer debt is hitting record highs, and millions of Americans are feeling the pressure. At the same time, the stock market keeps rising, unemployment remains relatively low, and the economy still appears strong on the surface. So, what's really going on? Are these just temporary economic fluctuations? Or are they warning signs of something much bigger? In this video, we'll break down the key signals flashing across the US economy right now, from inflation and rising debt to housing market stress and global trade tensions. By the end, you'll understand why many economists believe the next few years could become one of the most important turning points for the American economy. Rising inflation and the cost of living crisis. One of the biggest warning signs in the US economy is rising inflation. Inflation means the general increase in prices for everyday goods and services. Over the past few years, the cost of food, housing, healthcare, and transportation has gone up quickly. When prices rise faster than wages, people lose purchasing power. This means the same paycheck buys fewer things than before. Many households now spend a larger share of their income on basic needs. Groceries, rent, electricity, and fuel take up more of the monthly budget. Families often reduce spending on entertainment, travel, and non-essential products. Businesses also face higher production costs, which can push prices even higher for consumers. Another concern is long-term inflation pressure. When inflation stays high for a long time, it creates financial stress for both households and companies. Economists closely track consumer price data to understand whether inflation is slowing or continuing to affect the overall economic stability of the country. Interest rate hikes and the Federal Reserve's strategy. To control inflation, the Federal Reserve uses a key tool called interest rate policy. When inflation rises too fast, the central bank increases interest rates. Higher rates make borrowing money more expensive for businesses and consumers. This slows spending and reduces demand across the economy. When loans become costly, people are less likely to take mortgages, car loans, or credit card debt. Companies also reduce large investments and expansion plans. As spending slows, pressure on prices can begin to decrease. This is the main goal of the Federal Reserve's strategy. However, raising rates also creates risks. Higher borrowing costs can slow economic growth and reduce business activity. Some companies may delay hiring or reduce spending. Financial markets also react strongly to rate changes because they affect investment returns and corporate profits. Growing US national debt and government spending. Another major concern is the rapidly growing US national debt. The national debt represents the total amount of money the federal government owes to lenders. This debt increases when government spending is higher than tax revenue. Over many years, large budgets for defense, social programs, infrastructure, and economic support have expanded the debt level. When the debt grows, the government must pay more interest payments each year. These payments can take up a large portion of the federal budget, leaving less money for other priorities. Economists worry that rising debt could limit future policy choices during economic crises. Another challenge is the need to sell government bonds to investors. If investors demand higher returns, borrowing costs for the government increase. This creates pressure on public finances. Some experts argue that responsible budget planning and fiscal policy are necessary to manage long-term debt risks and maintain economic confidence in global financial markets. Stock market volatility and investor uncertainty. Financial markets often reflect the overall mood of the US economy. In recent years, the stock market has experienced periods of strong gains followed by sudden drops. This pattern is known as market volatility. Volatility increases when investors feel uncertain about the economic outlook. Several factors contribute to this uncertainty. Changes in interest rates, global conflicts, energy prices, and corporate earnings all influence investor decisions. When investors worry about slower economic growth, they may sell stocks quickly. This can cause large daily movements in major market indexes. Volatility also affects retirement funds, investment portfolios, and pension plans. Millions of people depend on the stock market for long-term savings. Sharp market swings can create anxiety for both small investors and large financial institutions. Job market changes, layoffs versus employment growth. The job market is another key indicator of economic health. In recent years, the United States has seen a mix of strong employment numbers and rising layoff announcements in certain industries. Technology companies, for example, have reduced thousands of jobs as businesses adjust to changing economic conditions. At the same time, other sectors such as healthcare, logistics, construction, and hospitality continue to create new positions. This creates a complex labor market where job losses and job growth happen at the same time. Another factor is the shift toward automation and digital technology. Many companies invest in software and machines to improve efficiency, which can reduce the need for certain roles. Workers may need new skills and training to adapt to these changes. Housing market slowdown and mortgage rate pressure. The housing market is another area showing clear pressure in the U.S. economy. One major reason is the sharp increase in mortgage rates. A mortgage rate is the interest charged on home loans. When rates rise, monthly payments become much higher for buyers. This makes it harder for many families to afford a house. Higher mortgage rates also reduce housing demand. Many potential buyers delay purchasing a home because the loan cost is too expensive. As a result, home sales slow down in many cities. Some sellers also hesitate to list their homes because they would need to take a new loan with higher interest. Another issue is the continued shortage of affordable homes. Limited supply keeps prices high even when demand weakens. This creates pressure for first-time buyers trying to enter the market. Consumer debt reaching record levels. Another growing concern is the rapid rise of consumer debt in the United States. Consumer debt includes credit cards, car loans, student loans, and personal loans. Many households rely on borrowing to manage everyday expenses and large purchases. As the cost of living increases, more people turn to credit cards to cover basic spending such as groceries, fuel, and utilities. Credit cards often carry high interest rates, which means balances can grow quickly if payments are delayed. Over time, this creates a heavy financial burden for many families. Rising consumer debt also increases risk for the broader economy. When households owe large amounts of money, they may reduce future spending to focus on paying down loans. Lower spending can slow business sales and economic growth. Financial experts closely monitor debt levels, repayment trends, and default rates to understand whether household finances remain stable or face increasing stress. Global economic tensions and trade challenges. The U.S. economy is strongly connected to the global economy, which means international events can quickly affect domestic markets. Rising trade tensions between major economies create uncertainty for businesses and investors. Disagreements over tariffs, technology access, and supply chains often disrupt global trade relationships. Tariffs are taxes on imported goods, and they can increase costs for companies that depend on foreign materials. When trade barriers increase, businesses may struggle with higher production costs and delayed shipments. This can also lead to higher prices for consumers. Another issue is the shift in global supply chains. Companies are adjusting where they manufacture products to reduce risk from political conflict or trade restrictions. These changes take time and require large investments. Economic stability also depends on conditions in major economies such as China, Europe, and emerging markets. Because global demand plays a key role in U.S. exports and international business activity. What experts predict for the future of the U.S. economy? Economic experts continue to debate the future direction of the U.S. economy. Some analysts believe the country may experience slower growth as higher interest rates reduce spending and investment. Slower growth can affect corporate profits, hiring decisions, and consumer confidence. Other economists remain cautiously optimistic. They point to strong innovation, technology development, and business investment as factors that could support long-term expansion. The United States still has one of the world's largest and most dynamic economic systems. Another key factor is the path of inflation. If inflation continues to fall, the Federal Reserve may adjust its policies, which could help stabilize financial conditions. Lower borrowing costs would support housing activity, business investment, and consumer spending. Most experts agree that future economic trends will depend on policy decisions, global events, and financial market stability over the coming years. The U.S. economy is facing serious questions, and the next few years could shape the future for millions of people. What happens next may affect jobs, prices, and global markets. If you found this breakdown useful, like the video, subscribe to the channel, and share your thoughts in the comments below.